Okay, so I'm recording this because I actually lost my save, so I'm going to have to re-record this lecture. So I'm going to get recorded for you really quick. This is indirect and mutual holdings from chapter 9. And what we're going to look at is when a parent controls a subsidiary company through indirect holdings. So what would happen is a parent buys a subsidiary or a portion of a subsidiary. At this point, we've only looked at what subsidiaries holdings are. So we've never looked at a situation where a sub owns a portion of somebody else. And that is a very normal concept in business. A lot of subsidiaries own portions of others. So what happens is if you have a parent who owns a sub and the sub who owns somebody else, then the parent has kind of an indirect relationship with the second subsidiary. So here is the relationship and what it looks like. So the first one we have is like basically father, son, grandson. And the idea is that we have one large parent, a big consolidated conglomeration like a Facebook. They own a sub. And that would be like, for example, if we owned, they owned another subsidiary like, well, I did a thing on WhatsApp. So let's put that one in there. So WhatsApp, right? Well, you know that like technical companies, particularly in tech, often have their fingers in a lot of the different pies as they are sharing software and information together. So they might trade this for partial ownership in another tech company. For example, you have a knowledge, but you don't have the money to fund it. So you reach out to another company and say, hey, you know, I'll share this, how to do this with you for a portion of my stock. And as I grow and build, then you will become, you know, instant millionaire, whatnot. So here's an example of parent owning subsidiary B. So whatever company WhatsApp may own, small tech company, you know, let's put in tech, okay, small tech. So what happens is as the parent has purchased their sub, all right, here's where things get interesting. The parent also, through their control of the sub, also has a small interest in this small tech company right here. So what you end up happening is the relationship with the parent who owns 80% of the sub, who owns 80% or 70% of sub B. So what you have to do is kind of multiply these together for your subsidiary, and that's basically what you have. And so you have a direct ownership of sub A, direct, and even though you're not involved in the day-to-day management or ownership of sub B, you're an indirect holder, an indirect relationship with sub B. Okay? So that's where the term indirect holdings comes from. The next thing is connecting affiliates. So this is a situation where the parent, unlike this first one, owns 80% of subsidiary A, right? So again, let's pretend like this is Facebook and WhatsApp, okay? Facebook. And I'll just put W for WhatsApp here, right? So WhatsApp. All right, or WA for WhatsApp, okay? But WhatsApp WhatsApp owns 40% of a small tech company, and I'll put that tech company here, tech company. And so they have a small relationship with a tech company, all right? Now, here's something different than this relationship here. The parent also owns a small portion of the tech company. Remember, they can own more than one thing. They own 20% of the tech company. So what you have to do is look at the relationship of A, sub to tech company, and then B, which makes this part indirect, parent to the first one is kind of an indirect relationship to the tech company. And then parent to tech company, which is direct. So the parent basically in this situation has a 32% indirect relationship with sub B, which is 80 times 40%, and a 20% relationship directly with sub B. And so what you have to do is go in and suss out the income in this. So that's basically what we're doing in this chapter. So when you look at the relationship, father, son, grandson, all right, there was only one direct relationship from parent, father to grandson, right? So in other words, the father had no stock outside of what was going on from son to grandson. Okay, so that one is and of course, you use the equity. If the son applies the equity method, father also applies the equity method because they have an equity relationship, more than within that 20 to 50% relationship. And the controlling interest share includes these two things. Okay. Now, again, when you look at the pop son and toy relationship for father, son, grandson, you can kind of see that the earnings are separated out. And again, the best thing for you to do when you're doing this homework, and I really wish I hadn't accidentally deleted it because I made all these screenshots. I'm going to try and go back and find them as we're going through this lecture, is to pull up this example with pop and son and toy from your books, just to get like a good flavor of like how to do this problem. Because what happens is in the PowerPoint, it doesn't give you everything. It just gives you like a snapshot, and I'm going to try to see if I can go in and actually screenshot it from my phone like I've been doing in the past and put it in too. But this separate earnings, the other thing that you need to realize here is these separate earnings, right? So you have pop, son, and toys, separate earnings. Pop's dividends that they're sending out, okay, those are for outside people that are investing in pop. These dividends are coming out of son and toy, right here, 20 and 30. These dividends are things that pop is going to get, right? These are going to, or these things are going to affect pop, just like the dividends are going to be an effect on son. So you have to kind of look at the dividends also, because pop owns a portion of son's earnings. Pop is also going to be concerned with that for their reporting and their consolidation, just as son is going to be concerned with toys earnings and their consolidation. Okay, so let's look at son applying the equity method. And the first thing that we're going to capture here is their income from toy. All right, their investment in toy. So that's going to be something they are going to end up getting cash dividends, right? Because remember I said son was concerned with the cash dividends that were being paid out. This 20,000, they're going to take this 20,000 right here, multiply it times the 70%. And what this is right here in the journal entry is the dividends that are getting paid out by toy to their shareholders, and son is a shareholder in toy. So that's how that comes into play. Then we're going to look at the next thing we're going to do is we're going to look at toy's income. So let's look at toy's income real quick. Remember that son is a 70% shareholder of toy. So toy's income was 40, right? So we're going to take the 40 and multiply it again times 70%. And that's where we're going to get the amount, their portion of toy's income. Okay, so now we've got that part done. We'll do pops on part 2 so that I can make 2 captures here. So I just had to take a break. Sorry, get a little drink. Okay, so the next thing we look at here is pop doing the equity method. Okay, so remember that pop is going to be dealing with son here. So pop has got to take in the cash dividends that son paid out. If son paid out dividends, pop is an 80% shareholder, so pop gets to take in their portion of the dividends. So they'll take the the 30, which is the dividend Sun paid out, and multiply it times 80%. Oops. Bad writing here. If I can erase this really quick. Alright. I'm going to try and be better at like mouse writing. I'm getting better. Times 80% right here. Okay, so that, there again, this is going to be the amount of dividends Sun is paying out, and Pop is an 80% owner of Sun. Okay, now this is where it gets a little tricky. The investment and income from Sun. There's two things that Pop has. They get to take in the separate earnings from Sun, right? They get to take in these earnings right here from Sun. So they get this part right here. But remember, Sun, within those earnings, took in a portion of Toy, or 28 of Toy from up here. Remember this part right here? Right? So Sun actually brought in some stuff. So in Pop's journal entry, okay, and people get confused because they're like, is this being counted twice? And I'm like, no, because it's two different books. So, and Pop will be reporting that consolidation in their consolidated income statement. So what happens is they actually come in here and they show the 28. We're just showing things. It's not like the money is getting duplicated. They show the 28 from Toy, right? Plus they show Sun's separate income. And here you go. So if you go into your homework and you're on exercise P, actually, hold on, I got your homework on a separate screen. I'm going to yell that out really quick. It's actually exercise 9-3. You can see a relationship between lake, place, and marsh. And that's basically the kind of the same idea of the step down. You just need to make sure you show all the different incomes. And the best way to do it is to start at the bottom. Start at the bottom. Get all that sorted out with the lower level first. Figure out what money they're making. And then move to the second to the last. And then move up to the parent and take everybody's income in. The only difference between what we're doing now and exercise 9-3, and I do have check figures in there, is it's not father, son, grandson, it's affiliates. So it's not too terrible. Okay, and you can see here how that works. Basically, I have this particular spreadsheet in the lecture the same way I set up the spreadsheet in exercise 9-3. Okay, so this one's more similar to your homework, and it adds indirect holdings and a affiliate relationship. So here's what we've got. We've got separate income, and the best thing to do is just kind of draw little lines when you get started. And remember that the dividends are going to relate. The Ty's dividends are going to be applicable to Sal, right? And Sal's dividends are going to be applicable to Pet, Sal. The next thing that you have to think about is Pet is going to get a portion of Sal's separate income, and Sal's going to get a portion of Ty's separate income. Okay, so we know that from the father, son, grandson holdings. All right, so also if Pet has a portion of if Pet has a portion of Ty, Pet's going to be interested in that too. And so that's a separate thing. I'm going to go ahead and make another little line so you can kind of see how that works. Okay? So it's just like sorting out who gets what in the relationship. And remember that everybody on their separate income statement, because this is where most people get confused, has to show, everybody has to show everything. And it's not double counting it to do that. Okay, so here's some intercompany profit, upstream and downstream. I'm not really worried about that. I'm probably, when we get to this part, I'm going to skip this. But just if you want to go deeper into the learning, definitely look at the upstream and downstream non-controlling, controlling interest. I'm most concerned with the split. Okay, so let's look at that, the split. And of course here we've got the investment balances calculated. All right, and you could see here the different amounts in the split. But what I'm most concerned is right here, separate income. So here again, the separate income, we did that from previous chapters, so I'm not going to spend a ton of time. You have to come in and take out any of the upstream and downstream, and you've done that in previous chapters. Here's the allocation. You have to start with tie, and here again, allocate to pet, 60%, allocate to Sal, right? And then you have to look at Sal as a non-controlling interest. And so you have like a few things going in to this situation. So again, you can see here, basically, if we go back and you look at this right here, 60% to pet, 20% to Sal, 20% NCI, right? The NCI being over here. I'm sorry, I didn't mean to say that Sal was the non-controlling. I heard myself say that and I'm like, stop, you're saying it wrong. So I apologize. But you see right here, you have to break it out between the two. All right. And that's all you're doing. It's just breaking out the income and the dividend and the distribution. Do the income and the dividend distribution separately. This is probably one of the easiest things you'll do in the class. It's super easy. Just the breakdowns between the two. And if you look at your sheet too on exercise 9-3, I made an incredibly friendly walkthrough sheet. So I think you all could do this without a ton of help. But you can see once you get the incomes and then just breaking them down between the two, don't forget the non-controlling interest. You'll be fine. And I'm going to let you look over your work entries again. You can see this. If you want to deep dive this and get into everything, feel free. I did not go this far in the homework. All right, so the last thing I'm going to talk about, and I'm not going to talk a ton because there's not a homework problem on this, and I know that we've got a lot to cover this week, but I want to talk about mutual holdings. I think I mentioned this in class, so it's kind of like something I wanted to follow up. This is the stuff that you hear about on the news where something's buried deeply in a company. This is how it gets buried. I basically, and I'm not going to do treasury stock too, but if you want to go down this rabbit hole, this is exactly how this happens. In this particular, mutual holdings is something that happens. And a lot of this, and I think I put in my discussion this week, when you get into that really deep accounting, forensic accounting, a lot of this can be traced to tax. There's reasons for them to do it for tax reasons, just to share. So here again, we have a situation where also there's reasons to do this again with the technology company because they have information but no money and they need cash flow to get some runway to get something off the ground. So they'll share a part of their company, even things like setting up legal work, legal papers. A lot of lawyers, particularly in tech, have become instant millionaires because they volunteered services in exchange for stock or in exchange for some sort of control. So in this particular case, parent and sub, parent owning part of sub and sub owning part of parent is a mutual holdings. When they hold a little bit of each other, that's where this comes in. Parent sub and then sub owning another part of sub B. It can get very deep. You can, and these, we're showing 2 or 3 levels. Sometimes these levels can go into very deep levels, like 5, 6, 7, 10 companies deep. And it's quite a bit to sort out who's actually in charge, where the money is going, and who's getting it. So my final thoughts on this particular part of this week is to make sure that you know how to do a simple allocation, both father, son, grandson, and a simple mutual. When you get this question on the CPA test, you're not going to get a triangle. So you need to know, like, a lot of times when you see the questions, you've got to sketch them out so you can see what you're actually being asked. And this is a great example of it. Once you do it once or twice, it's really not that hard of a question. But surprisingly, a lot of people miss this type of question on the test because they're just not there with being able to write it out and sketch it out. So make sure you sketch it out. Once you see the father-son, grandson relationship, the math is super simple. And I would think you would probably see something like this on a major exam, CPA, CMA, something like that. So, all right, have a great week this week. Thank you.